Hello, this is Joseph Gillette with Venture Capital Cross. Today's video is the difference between trading and investing. And today is October 13th, so over the weekend we saw massive volatility in all markets, but led by crypto. There was some kind of flash crash, liquidation, and a lot of people have a lot of theories on what happened. Was it the cross-collateral obligations that traders had, like they were using altcoins for their margin deposits, and that those assets went to zero even though there was no selling? Or was it some kind of exchange-driven manipulation to hit the stops, or a big whale in the market manipulating the market? We don't know what happened, but a lot of people lost money, and it's sad because the basics in any trading classes, they teach you use a stop loss, don't use leverage, or if you do, use it very wisely and only in specific moments. Like, for example, you want to just scalp the market for a few minutes, like getting in and out real quick. You can use big leverage. You don't sit on leveraged positions for a long time. It's just, like one guy told me, it's like carrying a big stop sign on your back. And you don't want to get stopped out. And I mean, when we were trading FX, the dealers would go stop hunting, and they would see all the stops, and they would just run the market to the stops where most of the stops were, and they would just hit you on both sides. They'd run it up, run it down, and they'd hit those stops because it's usually just above and below resistance points. And that was on a daily basis. So I can't imagine sitting on a huge position with lots of leverage in one direction on the market, and you're unhedged with no stop loss. I mean, that's insanity. I'm not surprised that this happened this weekend. I'm surprised this didn't happen sooner, because Bitcoin has went down 90% from inception. So would I have had the stomach to suffer those losses? Absolutely not. I would have sold. So I actually bought some Bitcoin in the early days, and I got hacked, and I kind of gave up on it. But the point is that trading is tough. Now, even if you had done all these things, suffering through volatility like this is unpleasant, no matter how you look at it. Let's say that you hedged, which you can do now with Bitcoin. You can take short positions. There's now all kinds of different market correlations as far as Bitcoin versus the S&P versus gold and silver versus something is always. When Bitcoin's going up, actually what's happening, most people don't know this, Bitcoin is denominated in US dollars. So Bitcoin is actually a Forex pair. When you see the price of Bitcoin, it's like 115,000 this morning. It's against the US dollar. So if you converted one Bitcoin into US dollars, you'd have $115,000. So it's denominated in US dollar. So when you see the price of Bitcoin going up, what's actually happening, if you reverse that, the dollar is going down. So Bitcoin is just a reference point against the US dollar. And that's the same with like dollar yen and all the base dollar Forex pairs, dollar Swiss, euro dollar. If euro dollar pair is going up, that means the euro is going up and the dollar is going down. And you can look at it either way. I'm not saying that that's good or bad. That's just the way it is. So that's just a fact. So most people look at Bitcoin as that it's an individuality by itself, and it's not. It's denominated in US dollars. And what do people have to do when they buy crypto? So you open a Coinbase account, you have to first buy US dollars, and then the exchanges convert those US dollars into Bitcoin. And then it's basically, crypto is a closed system. Now, once you own the Bitcoin, you can convert it to Ethereum or another altcoin or whatever, but if you want to pull it out of the crypto system, you have to liquidate it to US dollars or euros or something else. But it's a closed system that by itself has no intrinsic value other than US dollars being pumped into it. And that's why I've always felt like that. Think about it like this. When the Bitcoin ETFs were submitting their papers to the SEC and the comment letters that ended up being scientific papers. Some of them were so 20-page like scientific papers. uh, there was one that really made me think. So what drives the price? Bitcoin is a closed system, right? So what drives the price up? Selling US dollars and buying Bitcoin. That's the only thing. In other words, there's multiple factors that can drive the US dollar up. Thousands of factors. It could be war news, it can be oil, it can be cross-border flows. So for example, Ford Motor Company bought Jaguar in the United Kingdom. They're sending billions of dollars to the Great British Pound. That's going to make the dollar go down and the Great British Pound go up. Supply and demand. You've got interest rates, you've got Fed policy, you've got things like in the US you've got M3. So the Fed can literally decide how much money is in the system. Now, interestingly, they've never taken money out of the system, but theoretically they could do that, and that's measured in M3. Then you've got the velocity of money, which is an economic function. So how money turns around, how quickly money turns around in the economy. So during a recession or during slow times, the velocity is very low. That means I got paid and I just saved the money, which is, in the big picture, savings is good, but you want the velocity of money to be high when it's good for the economy. That means I get paid on a Friday, within an hour I've spent all my money and that vendor went and spent that money, and then because it multiplies in the economy when we're all spending and the velocity of money is high. So you've got all these things that impact the US dollar, cross-border flows, travel, and that's not significant, but you've got so many things that influence the US dollar, but only one thing affects crypto. I mean, there's only one way to drive it higher, and that's converting fiat to crypto. So think about that. There's inside of crypto, I mean, you've got Bitcoin and some altcoins, but the altcoins don't have enough, there's nothing behind them. I mean, if you issue more altcoins to buy Bitcoin, it's going to drive the price of those altcoins down. So Bitcoin is the largest, it's almost like a monopoly of crypto, and then you've got ETH and some others. And the others are interesting, but the point is that you're always relying on that fresh capital coming in from the real world to keep the price up. And that's very similar to how a Ponzi scheme operates. And I'm not saying Bitcoin is a Ponzi scheme. I'm saying it's Ponzi-like in its behavior, in that it requires more flows from the real economy in order to support that price. Now, so for that reason, I've always felt like, I mean, Bitcoin is interesting, but investing in it it's volatile. So how do you invest in something that's so volatile? Now, then you take a step back, and what's the difference between investing and trading? Trading is basically like day trading, where you can buy at 9 a.m. and sell at 10 minutes later. You're just buying and selling, you're trading. Trading any asset can be interesting and fun. I mean, you can trade, now people on Polymarket are trading weather, and they're taking bets on if someone's going to win an election and all kinds of stuff. So that's fine. But you got to ask, are the markets liquid? Are the markets manipulated? And when I say manipulated, I mean, like, for example, the stock market, a company can decide how much shares are out there in the market. And then you've got market makers whoever controls the supply controls the market. And like, there was a couple brothers that tried to do that with silver by hoarding all the silver, and then they could manipulate the market. So market manipulation is not necessarily, I mean, anybody can potentially try to manipulate the market. So the reason I always liked currency markets, because I mean, the FX banks were accused and found guilty of manipulating the markets, but even in that case, the manipulation is limited because they had to work together. So like, one bank cannot manipulate the market. So the cool thing about FX is that in this WM Reuters case, you can look it up, in 2015, they paid 15 billion fines for manipulating the market and hosing over the customer. But they could only do that through collusion. And that's the important thing, is like, Deutsche Bank couldn't wake up in the morning and say, we want the US dollar to be here, without getting all the other market participants to agree. Now, if you get all the other market participants to agree, that's not manipulated market that's market making. You're basically selling them on something. You're basically selling a policy. And when the president of the United States or when the European Union chiefs are giving their speeches, they're pumping their currency. They're pitching their currency, and they're trying to say that the US dollar is stable and we're going to grow your economy, so use US dollars because then you're going to be able to sell Coca-Cola and live a good life and have kids and make good business, basically. We're always pitching our currencies, so people think it's political, but it's not. It's a business. The US dollar is a business of the United States, which is not backed by nothing, like Gerald Celente likes to say, and a lot of people like to say. It's not backed by nothing. It's not fiat, which the origin of the word fiat goes back to decree by the king. So the king said it's worth XYZ. That's not true. It's backed by the entire U.S. system. And the U.S. system is massive. The Fed, and let me say a couple good things about the Fed. Everyone is critical about the central bank and crypto, and I am critical too. Don't get me wrong. Our financial system is outdated. But let me give some credit to the Fed. The Fed manages a global economy, which is very difficult. If you guys have ever lived in another country, you know very well it's not easy to run a country with a currency because you've got a lot of different forces that want a lot of different things. You've got all different kinds of economic actors that want to do different things. You've got banks, you've got the industry, you've got foreign influences who will buy up the currency. You've got foreign speculators, hedge funds that want to manipulate your currency. So even if you're the United States, you've got people who want to attack you. Like China, for example, who they always say that China is a threat to the United States because they can create financial attacks on the US system. Well, the Fed manages all this and they do a pretty good job, I would say. I mean, they obviously have a lot of room for improvement. Nobody's perfect, but at the end of the day, the US dollar is stable. Now, inflation is a problem. That's a separate problem, which is toxic because you're eating value, especially from the working class, and it's the working class that supports, or if you want, the manufacturing class, meaning not only the human capital, but the machines, the factories that supports the US dollar. So yes, our value has been eroding over time because of the fact that we've inflated the value from the manufacturing class to the aristocracy, and that mechanism doesn't create value per se. Okay, so that's been the whole idea of offshoring. The upper class or the owners, the shareholders of these big companies are making money, and they're taking those profits and they're turning it into more profits, and it's kind of like a financial game. So the rich have gotten really rich and they've inflated away all the manufacturing base, which supports the U.S. dollar. So I'm all on board with that argument. We need a new financial system, and I'm developing something. It's called intelligentism. It's basically a value-based currency, and the idea is that any currency that allows, like crypto, for example, that allows billionaires to be created, is wrong. So crypto, we've got more of the same. You've got greed. The problem, let's just take a step back. The problem with the system, capitalism works. The problem is we need to punish greed and hoarding. Greed and hoarding are the two biggest toxic forces in capitalism. So what happens, it's like a big game. Look at it like Nash equilibrium, like game theory. So you've got it's the turn of the century. It's like the Wild West. It's like 1900, right? It's like 125 years ago. It's a total Wild West. You've got factories. You've got immigrants coming. You've got Teslas here doing that. You've got all these different things. And what happens is the wealthy people establish themselves like monopolies. And then those monopolies use their money to just entrench themselves as monopolies and make it like an impenetrable wall between the monopoly and everything else. So the problem with that is it stifles innovation. So you have these cycles where you get lots of innovation and then the monopolies form because those people who created the monopolies, right, they then hoard all the money They say now I'm a billionaire, and I'm not going to share it. And it's not about sharing or charity. Forget all that. It's economically, this becomes toxic because they have no incentive to innovate. Now, originally, in the like after the Civil War, the incentive was we need to build infrastructure. So entrepreneurs got together capital and resources, and they built the railroads. They built the whole economy. They built housing. They built factories, and America lived pretty good since the Civil War. We've had, generally speaking, a constantly improving life. So obviously, like in the 1900, let's say, and around that time, we didn't have workers' rights. So over time, though, we had more and more workers' rights after the Rockefeller murders, where all these factory workers in, I think, Colorado, miners were picketing, protesting for more wages, and the boss hired some thugs to just break up the mob and killed a couple or I don't know how many details, but you want to have balance. The universe is all about balance, and this is a balance between good and evil, if you want, although it's more complicated than that. And so capitalism should be a good balance of everything. So you should have that innovation, that incentive for people to invest and create new paradigms. But at the same time, you don't want them to become so fat and greedy that they're sucking all the value, right? Like the robber barons did, and establish a monopoly class that basically their whole value is sucking value from everyone else. That's not valuable. So when we look at the George Soros and the NGOs, forget that if you don't like what they're doing. Forget all that. Forget all the ethical issues. Just look at it economically. There's a class of people. Let's say that they're not people. Let's say that they're NPCs. They're just like computer characters. They're sucking the value of 99% of the working people. And by sucking value, I mean we're not developing anything. And if you look at it, aside from telecommunications, very little has been developed over the last 50 years. Then all of a sudden, in the last 5 years, there's just all this stuff is being released and discovered. So, the answer is they were hoarding it. So the rich, the aristocracy is not only hoarding technology, not only hoarding money, they're hoarding technology, they're hoarding resources, they're hoarding things like space travel, time travel, life extension. You don't even want to know. And I've seen some of this stuff. It's nuts what they're hoarding. So we want a system that encourages, that means incentivizes investment and innovation, and disincentivizes or discourages greed and hoarding. And so I'm making this argument because we're contrasting trading versus investing, okay? So going back to what I was saying about Bitcoin, trading is cool and trading is fun, and you can trade and you can earn a living trading. I'm not knocking trading. I traded for 20 years. I did FX, and I was a terrible trader, so I developed algorithms, and the algorithms would trade for me. And I think that's a cool thing. But when you're trading, you're not creating any value. So a lot of people lost money, and some of these stories were heartbreaking for me. I'm reading this and I want to vomit. It's terrible. Some guy lost $30 million in a weekend, and that was his whole net worth. 100% of his assets were in this Bitcoin or whatever he was doing, and he lost it all in a couple hours. And it makes me feel bad. So I'm thinking, what if some of that money, let's say you take half your money, let's say you have $30 million, or any amount, it doesn't matter, a million. Take half, you trade it, fine. The other half, you invested in venture capital. You've got SpaceX, you've got companies that are continually... Now there's a couple, let me just, before I get into that, there's a couple things about private markets. They don't go down. So you don't have to worry about that. In a way, it's like they're always going up. Now, they don't go up so fast, so you're not going to, you can't get the kind of returns that people have become accustomed to in Bitcoin, for example. You can't quick, buy, sell, and then you made millions of dollars. It doesn't work like that. You've got to be patient. You've got to wait. But if you wait years and years and years and you get the right one, There were Uber seed investors made 500,000% returns from seed. Now, that's unusual. That's not normal. That's what everyone's chasing in venture capital, is to get the next Uber. But even in those cases, those investors had to wait, I think it was more than 10 years for sure. It might have been 15 years, because it was from seed. It was even before Uber was really out there. It was the seed investors that made the most money. Once Uber was on Series B and C, when the big institutions were investing, it was less. I mean, they made money, but you've got a venture capital chart that I'm going to write. It's my favorite chart. It's just risk versus return. And I should probably take a picture of this. It's real simple. It's basically algorithmic. And here you have the seed investors, okay? The seed investors have the most risk and the most return. It's like astronomical. I mean, you can lose 100% or you can have a huge return. And then over time, like Series A, B, C, it goes down. Now, the unicorns are like here. So the unicorns, like SpaceX and the bigger companies, you have much less risk. Why? Because they're very well-established companies. So SpaceX is a well-established company. They have multiple business lines. They're doing great with Starlink. They're just killing it. They're well-established. So your risk is low compared to the seed. But your return is also going to be low, because it's such a huge company. It's a 400 and change billion dollar company. So your return, I mean, it might double, it might triple, but it's not going to be 100x, because it's such a big company already. So that's where this chart, and it's like logarithmic. I mean, it's really logarithmic. So in the beginning, the investors have just insane risk and could potentially get insane returns, or they could get zero. There's a lot of types of investing. I'm not necessarily saying that venture capital investing is the best form of investing. There's all kinds of ways to invest. I just like venture capital because of the value and the growth story. So that's what I like about it, is the entrepreneurs, because I'm an entrepreneur. I love to build things. I'm a builder. It's just in my genes. I build software. I even, in my spare time, I build little like furniture and stuff, shelves, desks, stuff like that. I just like to build things. I like to build businesses. I like to trade, and I like to trade, but the thing about trading is you're not really creating any value. Like this whole thing about you're providing liquidity to the market. Traders don't create any value. Venture investors do. So another story about venture investing is Christopher Columbus. Now, everyone knows the story of Columbus. What they don't know is it took Columbus years, I think 10 years, to get the money that he needed to come to America, which he never actually reached America, but actually to come across the Atlantic. It was, in today's dollars, it would have been hundreds of millions of dollars for the boats, for the logistics, for the men. It was a year-long trip, and they brought with them guns, scientists, like they were going to map out cartographers, things like that. They were treasure hunters, but the whole expedition required financing, and Columbus was not a rich guy. I mean, he was aristocracy, but he wasn't capable of funding himself. So he created the corporation. And another interesting fact, the corporate structure goes back to the British and Dutch East India companies, which were ventures, real ventures, and the idea was we're going to share the risk and we're going to share in the returns. So when the British wanted to go to India, it was a business. It was the British East India Company, and it had the blessing of the British government. And actually the royals were invested in that, but so were the other aristocrats, the dukes and the landowners, the barons, the Rothschilds, the wealthy people in that time invested in that. And so it was a shared risk with a shared reward, and that's what built Apple Computer, because companies like Apple need capital, they need resources, and like Andreessen Horowitz has said, these VC firms have become a lot more than just capital providers. They not only provide, they just do a number of things. They provide coaching. They can even help you find talent. They can help guide you because they've seen it, what works and what doesn't work. They can make introductions for you. They can provide legal counsel when it comes to like regulation. If you have a product that might be regulated, they might have someone in Congress, or they might have a law firm that can help you patent things, or just whatever you need. And their capital is invested. So bacon and egg breakfast, the chicken is involved and the pig is committed. So they're committed. They're all in, right? And so they have an incentive to make new things work. So that's why I so much love the venture capital market. But it's by far not the only market. There's lots of ways to invest, and of course one way is to just invest in yourself and your own business, start a business. I mean, that's the coolest thing. And then you're on the other side of the fence. Then you're doing something you love and that you're passionate about, which may be trading. You know, I'm not. This is not a criticism. I just feel bad that when I hear stories about people losing money, and so I just wanted to contrast the differences between trading and investing. And when you're investing money in a business, 9 times out of 10, I mean, there's exceptions, but 9 times out of 10, that business really needs that capital, and they're really doing something. They're really creating value. And if you look at companies like SpaceX has tens of thousands of employees. So all of those things, or if you look at Airbnb not only made money for investors, but it has created an income stream for the power hosts. So Airbnb is a very, I think, good example where something didn't exist and then it did exist, and that's the Airbnb ecosystem. So these Airbnb rentals, most of them, the hosts do really well. I mean, there's ups and downs with real estate and the economy, and I think COVID net was a boost for them. I don't know. I haven't looked at that, but I'm just some things I read. I think that it was good. COVID was good because people were able to kind of work remotely and just take time in a more private setting, and they're more afraid of like a hotel situation, and Airbnb is more like private for your own family or coworkers. But then there have been times where they've been suffering a lot and they've had to pare back on their property portfolio. So I know that it can be volatile. But the point is, it's net good for all the Airbnb super hosts, I think they call them. So we're looking at before and after for investing. So investing creates value. So the founder of Airbnb created value for investors, and he created value for the people who are now earning a living by selling those Airbnb properties. So that's what's interesting about investing. And of course, most people look at investing as just passive investing, which is here's the money and that's it. And I guess what I'm saying is the venture firms are now looking at investing as more of, they're almost like general partners. They're coming into the situation and they're saying, okay, here's the money. How else can we help you? And sometimes they don't. Sometimes the company is just, we just need the money. And sometimes they're very involved. They sit on the board. They're actively day to day working with those guys in a number of ways. So I think that does it as far as what I'm trying to say. And I feel my heart goes out to all the traders who lost money, and I'm sorry. I want to apologize to you guys. I mean, it's terrible when you lose. I know, I've been there. I've had several situations where I had an account wiped out. That it just, it happens. Trading is just like that. And so sorry about that. But what I always learned when I took classes on trading is diversification, is hedging. You take 100% of your assets, you split it up, put half in some kind of semi-long-term investments like venture funding or something local, maybe a rental property or something like that. Doesn't have to be. I'm managing a venture capital business, so I'm obviously biased. But there's lots of ways to invest locally. trade some of the money, and when you are trading, you should always use a stop loss, hedge your bets, and that's going to limit your profits. So hedging, it costs money, so it's like insurance. I mean, you need car insurance or house insurance in case your house burns down, and most people might never need it. But when you do, it's the prepper motto. It's better to have it and not need it than need it and not have it. So so you trade some of the money, and you withdraw your profits periodically, every month or every quarter or every year, and you keep your principal just like a capital, like a farm needs goats or pigs or whatever. Your capital is your principal. Don't eat into that. Take the profits out and parlay it into a small fortune. I think that's the road to success. That you can have a hybrid, and that goes back to like the hybrid capitalism approach. Everything is an optimization. You basically want to find that Goldilocks zone where you're making enough money trading, but you don't need too much. And what's the difference between you're making enough and you're making insane returns? Hedging and diversification. So you take some of that profit, take your profit on half, take half your profits, take that profit, make an investment. It can be an investment in a house. I mean, it doesn't have to be a business. Investing in any real assets or something that it's not going to like trading is all artificial. There's nothing, money does not exist. Okay, so if anything, you should diversify at least half of your money outside of the matrix. So you've got, let's say, $1 million in the matrix, crypto, stocks, whatever. Crypto is no different than stocks. I mean, stocks are not real. The companies that they represent are real, but the share market, the stock market, it's all a game. I mean, it's numbers moving up and down. You can get wiped out in the stock market. Look what happened to Tesla. So it's not like there's not really a safe place to do passive investing that's 100% safe. You keep your money in the bank, there's inflation going to get you. Everything's going to get you. Hard assets, the value of it is that it's going to exist. It's going to be there. You can use it. It's like investing in tools. If you're a carpenter, you get hammers and you get saws and finish and different things, and whatever is your trade or your skill set, invest in yourself. Take a Udemy course, get a certification, get a PhD. I got an advertising the other day from the local universities offering master's courses part-time for working people. You can do that. I mean, that's something that you'll always have with you, and no one can take that away. So that's the message of this: is hedging, and investing is one form of hedging. There are many. So I wish everyone the best, and I hope that we can recover from this, and may you have the high alpha in your portfolio, and may your investments manifest into more than you could have possibly imagined. Thank you. Have a great day.